You're all very welcome to this afternoon's lunchtime insights session, and thank you all for taking the time to come here today to listen to our session on the paper that we recently produced. So my name is David Creven, and I was the chair of the Life Insurance Risk Appetite Working Party, and so we're here today to give you, I suppose, an overview of the paper that we produced recently, which was called Developing the Risk Appetite Framework for a Life Insurance Business. First of all, I just want to thank the members of the working party itself, who are listed here. As the chair, I was very fortunate to have a really great group of people to work with in producing this paper. So thank you to each and every one of the people that are listed there. In addition, I'd also like to thank the Life Insurance Wealth Management Practice Committee and the Risk Management Practice Committee as well, because they provided a review of the paper. The working party itself was set up in about May of last year, and by December of last year, we actually had the paper complete, and we're in a position where we could send that through to both of those practice committees for their feedback. And then the paper itself was published in March of this year. So it was a relatively quick turnaround, and that was all down to the hard work of the members of the working party. So thanks again. There are two people up there that also are part of a general insurance risk appetite working party. That's Stephen Britt and David Koob. So we did work closely with Stephen and David just to ensure that we had, I suppose, consistency in approach and terminology across both life insurance and general insurance. And David tells me that they're very close to actually finalising the GI version of this paper as well. Some of you may have had the opportunity to take a look through the paper at this stage, but if you haven't, here's I suppose a brief overview of the paper. So the paper itself is set out as you can see here. And it's really, I suppose, the purpose of it was not to give a prescriptive approach to setting the risk appetite framework for life insurer, but more just to provide some food for thought as to the types of things that are worth considering when setting a risk appetite framework, and when also, going to the board to actually discuss what the risk appetite of the organisation should look like. Today, we're not going to cover all of these items, but we will focus on, as it says here, defining what we mean by risk appetite and the various terms that are often used in relation to risk appetite. We will focus quite a bit then on risk tolerances, risk limits, the difference between those, and also talk about some possible approaches to cascading of those tolerances and limits down into the organisation so that they actually can be used by people that are on the ground. And then we'll also touch on monitoring and governance. So we'll have a relatively quick presentation, maybe 30, 40 minutes or so. So we will have plenty of time for what hopefully will be an interactive and robust discussion afterwards. So at this point, I'll hand over to Mira Sardana.
So hi everyone, for those of you that don't know me, I'm Mira Sardana and I was the Secretary of the Life Risk Appetite Working Party. Now, a key aim of the paper we put together was to provide commonly accepted risk appetite definitions and give additional clarity around risk appetite terms. The definitions that we adopted were chosen after considering a range of definitions provided by a variety of bodies such as the FSB, APRA and the CRO Forum. We've brought these definitions together and added an insurance focus. Generally speaking, we tended to adopt definitions advocated by the FSB. So this slide here outlines the definition that we've adopted for risk appetite. Risk appetite represents the level and types of risks that an institution is willing to assume within its risk capacity in order to achieve its strategic objectives and business plan. The next slide provides an outline of risk appetite statements and the definition that we've provided. There are three key requirements that make up an effective RAS. It needs to describe the board's willingness to accept risk. It needs to have a link to the organisation's strategic business objectives, and it needs to be articulated in written form. It's important to bear in mind that there is no one-size-fits-all structure or design to a RAS. The requirements will differ depending on the size and complexity of the organisation's business. APRA Prudential Standard CPS 220 on risk management includes the various governance and review requirements of the RAS. Boards have a degree of flexibility in how they define the risk appetite and also in relation to the types and amounts of risks that they choose to have exposure to. The RAS should cover what the board believes to be the key risks of the organisation. So, for example, for an insurance company, these would be asset risks, insurance risks, and operational risks. Now, the CRO Forum proposed 4 broad enterprise-level risk categories for a board to consider when setting their risk appetite, and we've included these within the paper. These 4 categories are the achievement of target performance, preservation of capital, maintaining liquidity, and protecting franchise value. So the idea is for each of these risk categories, you need a clearly articulated qualitative or quantitative bound. Now, the Working Party spent a considerable amount of time discussing and debating the interaction between risk tolerances and risk limits. Risk tolerances articulate the boundary for the maximum amount of risk that an institution is prepared to accept. So, at a minimum, risk tolerances should be defined relating to enterprise outcome variables, for example, profit, liquidity, or perhaps even reputation. However, it is then typical to define risk tolerances at the next layer down, so relating to business units, products, and material risks. In comparison, risk limits provide operational controls on the activities of business units that manage risk on a daily basis. Risk limits provide a brake against excessive risk-taking within the organisation. So the distinction between risk tolerances and risk limits is that risk tolerances can be viewed as constraints on business outputs, while risk limits can be viewed as constraints on business inputs. Now, any business outcome or any business output can be viewed as a function of 2 things. That is a risk factor and an exposure to that risk factor. So one approach then would be to set your risk tolerance with respect to the business outcome and your risk limit with respect to the exposure variable or the business input which contributes towards the business outcome. Now, to provide you with a simple example to further illustrate this point, we can consider the capital return on a zero coupon bond. The business outcome in this example is the capital return on the zero coupon bond. The risk factor is the spot interest rate, and the exposure to that risk factor is the modified duration of the bond. The interaction function then is based on the spot rate and the modified duration, and these two will interact to give you your capital return. So then one approach would be to set your risk tolerance with respect to the capital return and your risk limit with respect to the modified duration. As in this example, the modified duration is the input that you can control. So effectively applied, risk limits are the manner in which management gives effect to the board's risk appetite and the associated risk tolerances. So the paper then looked at the components of risk tolerances, and these are the components that we thought needed to be in place for the risk tolerance to be clearly defined and understood within the organisation. So we identified 4 key attributes. The first is to identify the set of strategic outcomes that you want to look at from a risk tolerance point of view. So this could be profit or solvency, for example. Next, we need to try and understand the planned outcome and then what the tolerated outcome is. That is, how much are you willing to deviate from the planned outcome? The last piece, which is important, is the frequency of the tolerated outcome. That's important because it explicitly recognises that outcomes are uncertain. So you won't always want to have a 0% chance of outcomes being outside the tolerance level. Next, we considered the attributes of risk limits. So risk limits must be measurable, and ideally they should be testable. Remedial action can only be taken if the risk owner can tell whether or not they are operating within the risk limit. Risk limits do not necessarily need to be quantifiable or probabilistic, and risk limits should be sufficiently binding and unambiguous. We don't want to be spending our time discussing whether or not a risk limit has actually been breached. Lastly, the risk limit should be expressed in the language of the business. It is important that risk limits be expressed in the terms that risk owners and the business can understand, measure, and report upon. I'll now pass on to Josh, who will provide some insight on how risk tolerances can be cascaded to risk limits. Thank you.
Thanks, Mira. Okay, so I'm going to be talking about the challenging problem of how to cascade tolerances to limits. Personally, I think this is one of the more difficult aspects of the whole risk appetite framework. I think it's relatively, I shouldn't say easy, but easier to define what some of the tolerances are. But in terms of how you actually take those tolerances and push them down into meaningful risk limits in a very consistent way is actually extremely challenging. So one way to think about it is, as Mira said, I very simply think about tolerances as outcomes and risk limits as inputs into the business. And essentially those tolerances are set through a combination of management input and guidance and expertise, and the board essentially opining on where they want those tolerances ultimately to be set. So in an ideal world, you'd start with those because they're essentially defining the constraints on the business that the business needs to operate to. From a cascading perspective, that then puts the stakes in the ground to which you then are set up with a problem as to how to define those limits with respect to those particular outcomes. So essentially, it's an inference problem that you're faced with. So how do you cascade those tolerances to further and further levels of segmentation and granularity throughout the organisation? As Mira pointed out, there's different types of situations where that can be easy and other types of situations where that can be extremely difficult. In my experience, I've come across a number which are actually quite complex and difficult simply because the nature of an insurance company is, they're not simple organisations, they're inherently complex adaptive systems. There's lots of different moving pieces and parts to the jigsaw puzzle, and in terms of how you actually generate outcomes, it's very difficult to uniquely define a singular relationship between a single business input and an outcome upon which you want to provide a constraint. But it's the essence of the problem is you need consistency between those two elements, because if you're not defining your risk limits in a consistent way with the risk tolerances, then you're going to find you've got problems. If your limits are too binding, then you're essentially not going to be pushing up to and taking enough risk within the organisation. And similarly, if the other way, then you're not going to be taking enough risk within the business if you're defining your tolerances at a certain level. So you really do have to put a lot of thought into the consistency between the risk limits and tolerances. Essentially, the way I think about it is at the highest level, you kind of have the enterprise types of outcomes. You've got solvency, profitability, value, liquidity, and they're kind of the highest level aggregate types of outcomes. And then you work backwards from those. So you can typically cascade those into different business units, different product lines. There's other dynamics in there around credit ratings which influence multiple elements of those. And then once you kind of deal with that layer, you're cascading down another layer to some of those input drivers. And it's the question as to how you think about that cascading process and deal with some of the complexities that are inherent within that. One framework that I use to think about how to approach it from different types of mathematical techniques or other introducing other systems types of concepts, is to think about the nature of the problem. And inherently, I think it essentially leverages a lot of systems type of thinking here. So the example that Mira related beforehand about the use of a simple zero coupon bond and trying to use a very defined singular mathematical relationship between outcome on a capital return and exposure variable is a very simple example of a deterministic system where there's essentially no uncertainty in the relationship between that outcome and the input driver. Though when you're facing those types of problems, they're the good ones, they're the easy ones to solve because you can just use simple mathematical relationships to cascade one to the other. Another, probably the next most relevant or complicated level of sophistication of systems that you come across are complicated systems that are essentially characterized by one-to-many relationships. So we face these types of problems in our organisations all the time. Whether you're a valuation actuary, whether you're a capital actuary, you're basically using different models to plug in different variables, and you're characterising different types of relationships, and they're all characterised typically through many-to-one type of relationships. And they're great when you're trying to take information and you're pushing it through to generate an outcome. When you're faced with the reverse problem of trying to imply or infer an input constraint from an output of a particular model, it's a lot more difficult. And a good example would be the use of correlations, correlation matrices, linear types of structures to aggregate different risks to generate a diversified outcome. You can't push that information easily or readily back down through the correlation matrix to disaggregate it effectively. There are techniques such as Euler methods that you can do, looking at kind of marginal contributions to risk, and they give you one lens on how you can do that, but it's not straightforward. Segment analysis is something that is relatively straightforward when you're dealing with the hierarchical type of situations. And to the extent you've got GLMs, then there's approaches there that you can use to tweak certain inputs, almost take a scenario and sensitivity stress testing type of approach. The challenge you have with complicated systems that we all have to face is you've got to be very careful about the nature of the risk statistic that you're defining. So if you've defined a risk tolerance in terms of a VAR limit on some measure, then you need to be really careful because VAR is not a coherent statistic. So when you try and disaggregate it, you can run into problems with that statistic. A CTE, conditional tail expectations, tail VAR, that's a coherent statistic. So when you disaggregate that, you'll essentially get consistency in those techniques. Or those results when you're defining or using CTE to define the risk limits through to a risk tolerance outcome. But as we know, CTEs are not the easiest thing to explain to people. So we've essentially got the challenges to whether to use CTE types of measures in the cascading process, but communicate and define risk tolerances and risk limits more in terms of VARs that people actually get. And it's a lot easier to understand a VAR type of statistic. But inherently there's solutions there. When you're dealing with chaotic systems, luckily we don't have to deal with many of those in our line of work. Just give up. There's nothing you can do. Because literally a slight tweak to an input will have a completely unrelated impact upon the outcome. So if you're trying to cascade, if you're dealing with any type of system that's chaotic in nature, you just can't do it. A good example there is the weather. So the next one, which we come across a lot, are essentially stochastic types of problems. As insurance actuaries, we come across these all the time. It's the nature of insurance business. So frequenter statistics are very, very useful in understanding those distributions and using VAR measures, CTE measures to describe those types of outcomes. I guess the challenge with those types of situations is that inherently what you're saying when you're using stochastic types of models is that there's a level below which you don't really understand. You're just going to model it statistically, and so the only way you can cascade anything below that level is essentially looking at the number of observations that actually go into that statistic. So, it doesn't really help you when you're at that bottom limit of your model and you're actually modeling something stochastically. You can't really cascade anything further to that point. And then finally, complex adaptive systems is something that I've certainly spent a lot of time in over a number of years, and these are really characterized by many-to-many types of relationships. These are essentially, I think, the closest that we have to being able to model a lot of dynamics that exist within our organisations. And there's luckily a significant body of work around dealing with and understanding the dynamics of complex adaptive systems that enable us to model them in various degrees of sophistication. So I'm not going to go into all the details, but just following on from that point, here's a very simple example, and it's deliberately excluding the numbers. If you want the numbers, have a look at the appendix in the paper. But essentially what you're saying is instead of modelling things statistically, so you could actually say, if you're trying to measure operational risk, and you might say, okay, I'll draw a curve through our reputational losses that might actually occur, and I'll just model it statistically. That's nice, but it doesn't really give you anything that you can use to cascade a risk tolerance on that down further layers. Whereas a causal type of approach will actually say, well, reputation, that's a function of a number of things across our key stakeholders, our shareholders, our regulator, policyholders, our counterparties, how they perceive our reputation. And our ultimate reputation can be influenced by the states of any of those particular key stakeholders. Those things in turn are driven by things like solvency ratio, governance structures, could be other simple metrics like net promoter scores, which are in turn driven by things like brand, liquidity ratios, to the extent you're missing debt repayments on certain things. And a causal type of approach is all about trying to connect those business inputs that people are actively managing and monitoring to the states of, a key business output such as reputation. Now, it's not necessarily easy, but it's certainly achievable that you can actually start to define what some of those interrelationships are between those variables, because people inherently have a bit of a gut instinct for those. And there's also, analytic approaches that you can use to flesh out what the relationships are. The key benefit of this is that particularly if you're going to go into a quantitative modelling framework, you can then use techniques such as Bayesian inference techniques to formally reverse stress a risk tolerance that you set on, say, a reputation indicator or outcome down all the way and propagate that information all the way back down through those particular input drivers. And that gives you a self-consistent framework for actually mathematically deriving that. So there's a number of techniques that you can use, and I would suggest that before you go off and throw any of them, you actually take a moment to reflect what type of problem it is that you're actually dealing with, and use the right tool for the right problem. And I'll just briefly touch on monitoring governance before we throw it open to questions. So monitoring, I think this is relatively straightforward. Clearly, we need to be monitoring our risk appetite statement, our risk indicators, and that's why we try and suggest that quantitative indicators are very good, because they're inherently probably easier to monitor. It's really up to management to set up the infrastructure to be able to actively monitor those. I know for my organisation, we've actively moved towards a framework whereby we can define what these risk tolerances and risk limits are quantitatively, so we can more frequently and actively monitor against them, as opposed to being, a lot more qualitative in nature. And there's various mechanisms you can use to do that, whether it's risk dashboards or other operational metrics. I guess the final one is just to be aware that when you're pushing up to or at a risk tolerance or risk limit level, that doesn't necessarily imply that you're breaching your risk appetite if you haven't necessarily breached the frequency of that. It would certainly be giving you a strong signal, and management should be reacting to that. But to the extent you've set your frequency threshold relatively low, then you just need to be conscious of that. There's many examples of that where, in the banking space, where they're monitoring VaR limits on interest rate books, to the extent they're setting them on a daily basis, they're setting them at 99th percentile, then you're still expecting to breach, that every, couple of times a year, for instance. So just be clear and conscious of the frequency aspect of the RAS as well. From a governance perspective, clearly here the point to this one is all about engagement. So we need to be engaging all the key stakeholders, as well as not just the board, but the people who are operationally managing these risks in the business, so that they have buy-in to the risk statistics, the risk measures that we're actually going to hold them accountable for. Clearly the board's a key stakeholder in this, and they should be engaged both early through and obviously at the end of the process in terms of signing off on the tolerances. But it's really management, I think it's management's job to think about how those risk tolerances cascade appropriately to risk limits, because they're the ones pulling the levers on the business input side. So with that, I'll turn it over to questions. Just as by way of interest, can I have a show of hands as to who's at least read or scanned the paper at all? Okay, handful, maybe 10%, maybe pushing it. Okay, there is a lot of content in this paper. We think it's an awesome paper, so I highly encourage you to read it. We will be pushing it out to the IAA and other globally as well, because we did spend a lot of time looking at all the papers globally to ensure that there was, we'd taken their views into account, and particularly when we came up with the definitions, we spent a lot of time discussing and debating those, because there were some inconsistencies across the different papers that we came across, whether it was APRA papers or FSC papers or other papers, and we hope we've landed on definitions that we can all agree on. So with that, I'll open up to questions. Anyone want to go first? No? David, or Paul, do you want to have any comments?
I can ask the first question.
Yeah.
What feedback have you had on the paper so far?
So we had some feedback both from the LIWMPC and the RMPC.
Have you had feedback, for instance, from APRA?
No formal feedback from APRA yet, although Ian has joined us, so maybe that might change.
I can give you something later, but it's really good.
Care to expand at all on that, Ian?
Well, I think the definitions, for example, are right on the money, and it's probably one of the better documents that I've seen that brought all of those different concepts together. So I do think it's done a very good job. One observation I'd make, I think, is that the paper would benefit, and I know this is difficult, by having some examples of statements that would be in a risk appetite statement. So you give good examples of risk tolerances, really good examples. But what organisations often struggle with is, what do they put in this overarching risk appetite statement, which you talk a lot about, but it would be good to see some examples.
We did talk a little bit about that, and we kind of landed on not putting them in there.
Yeah, we probably shied away from that to some extent, more from the point of view of, we're trying to more encourage the people from the organisation and the board to actually really have the discussion as to what they want to see in their RAS. We then give examples of risk tolerances and risk limits, which should help form what the risk appetite statement should comment on. But yeah, we didn't take that last step, but we did discuss whether we should or not, but we shied away from it in the end. But take the point.
And there have been other papers that have actually done that. So it's not like there's a complete gap out there in that space.
No, it's true, but at APRA, obviously, we have the great advantage, privilege, really, of seeing many different internal documents, and the quality of the risk appetite statements varies quite a lot, and it's apparent that that if everybody could see what everybody else was doing, the standards would be limited considerably. And I suppose one could argue that that's a role for APRA. We need to be feeding more back to the industry. I think that's a fair comment. But there is a need to help organisations with this writing structure for risk appetite statement.
I mean, David Coob is in the audience. He's a member of the General Insurance Working Party on this topic, and they haven't yet to finalise that paper. So maybe that's an opportunity for the GI to take a leap forward. Anyone else?
I've got a second nastier question. If you can excuse the way the question is phrased, there have been recent problems in the life insurance industry in Australia. Most recently espoused at the appointed actuaries combined meeting. Do you think application, or how do you think application of the material that's here might have avoided those sorts of problems? For instance, were there adequate risk limits that were embedded into the disability income portfolios or the group life insurance portfolios that seem, to an outsider, have led to some of these problems?
It's a really good question. Maybe I'll have a few thoughts and then hand it over. My gut feel is I think it would have helped. The thing I find really valuable about the framework is that it forces you to think about the drivers, particularly when you're thinking about the cascading aspects. And even though it's part art and part science, the art part is really valuable because it helps you identify what those drivers are and think about what might be appropriate risk limits. You don't necessarily have to model everything to the nth degree. And I would have thought that even just going through that thought process and thinking about how our exposure to DI or other lines of business, how things might have deteriorated, and putting in place some risk limits on some of those key indicators might have helped.
Mm-hmm. Josh, just make another quick comment. The insurance risk or insurance risk tolerance is very rarely clearly articulated in these statements. So you see things like, we're an insurance company, we're in the business of taking insurance risk, so, we've got this vast appetite for it. But you don't necessarily see something that says, we're taking on group life insurance risks, and, there's a certain degree of volatility in the results, and we'll accept, based on a range of assumptions, we'll accept a certain degree of volatility in, say, profit. But maybe then you need to say you want to add a little bit for uncertainty because of all of the different factors of risk that you can't measure. But the point I'm making is that it's really interesting for an insurance industry. It's rarely very well articulated, and I think there's something that you could help with a lot. How do you articulate a risk tolerance for insurance risk? How does that then flow to your earlier conversation? How does that then flow into practical limits on, for example, the size of the group life plan?
Yep.
I'm going to take a slightly contrary view. With a lot of these structures around risk, the key issue here is the overarching culture. So I could have an extremely well articulated insurance risk limit and appetite, but fundamentally how is the organisation then viewing that and questioning what they're taking on? So I could quite simply say as an organisation, we're taking on more group insurance. Yeah, that sits within our overall risk appetite. We're not really changing the terms and conditions. The volatility should be the same. And so it comes down to, I think, also the strength of the culture that sits within the organisation and the questioning of what's being done. So there's different layers to this question, to the response. So yes, at a high level, there should be limits around the lumpiness of group insurance and how much you want to take on of that, and the types of different group insurance that you may want to take on to the organisation. But there also needs to then be the discipline about questioning the variations and what you're actually taking on from a business perspective. And we're talking about the negative side of risk, about taking, questioning the volatility you're taking on. It also should be what risk is out there that we should be taking on to also help the organisation. So it's also going to be two-sided. But I think it really comes down to the culture, and I really think to the well, if I want to be contrary as well, I actually think the CRO is the worst job to take in an organisation, because when things are booming, it's going to be an extreme amount of pressure on the CRO to sit back and say, don't take that group insurance scheme. I don't believe it's appropriately priced, it's too volatile, etc. And you'll see that they'll say it's 20% of our premium income. What are you talking about? You're putting the brakes on. So it does come down to the organisation's culture, I think. And I think we're in that evolution.
Josh, to what extent did you consider, or do you think it's appropriate to consider linking risk tolerances to things like risk margins that are in ledger statements? Or did you consider that, or do you think it's a useful concept?
No, we didn't formally consider it. And David, I'm not sure if you've had any conversations from a GI perspective in your working party,
So
but
risk tolerance with
respect to the risk stress margins,
risk.
the stress margins. No, we haven't. Yeah, no, we didn't formally consider it. It's an interesting thought. Yeah.
I mean, certainly when that makes sense to me in terms of if the logic requirements are meant to be risk sensitive, well then obviously your risk tolerance is an indication of the level of risk an organisation is meant to take on. So it's certainly worth exploring. Unfortunately, it's not something we looked at as part of this paper.
It is a good idea, because you can then start to cascade that down through, some of the operational drivers of those stresses and the external drivers as well.
And potentially you wouldn't be at the 99.5 percentile, that wouldn't necessarily be the tolerance.
Yeah.
It should be based on the same sort of approach, and so you can have a holistic framework that kind of links solvency and potentially the risk appetite.
Yeah, that's actually a really good idea. We should capture that for our next paper.
Just one other point to follow on from what Paul was saying. In the paper, we did state quite clearly about what should be in a risk appetite statement, and it is more obviously than just saying we're not going to we don't want to take on these types of risks. It was about clearly articulating the types of risks and the types of business that you do want to chase. So it was, there's two things: clearly stating what you don't want to take on, but also being very clear about what you do want to take on.
Josh, I've asked you this question before, but I'll ask it again just for the benefit of the group. In terms of things like risk limits, have you got a view on how to avoid that confusion between what could be a risk limit and what could be an existing business key performance indicator already? Because it appears in some instances you could, the two could quite easily get mixed up, whether it be the same good reason. So I don't know whether the panel have got a view on that.
Yeah, I think the business indicator is all about that, setting that expectation of around the business plan, where that particular variable or business input actually should be in order to hit your objective. The key risk indicator, risk limit, should really be your threshold of appetite around that, and there could be a range, an operating range that you might want to implement around that particular business driver, but then you would want to clearly express what that downside risk is to that, and then the question is, how do you do that, and how do you make it tie up to other constraints that you have on other variables in a consistent way? And that's the key challenge.
Josh, can you show the slide that had the reputation losses at the top and then I was interested in your reputation for this example. They had have a complex adaptive system sort of work through in terms of a quantified. I think that would be more challenging than other potential losses you could have put up there. I'm just interested why you chose reputation. Was it intended to say this is one of the harder ones, and you can use this approach to come up with a...
That's exactly right. Yeah, because we're all pretty good at modelling mathematical types of risks around insurance and asset risk, and we have big complex models to do that. When it comes to some of the softer risks, strategic, reputational, operational, it's dealing with fuzzier concepts here, but we all know what drives them, and importantly, there can be really important non-linear relationships governing them. So how do you capture those in a very simple, easy way? This type of approach is a way that you can use to do that very clearly and very transparently as well, because your reputation is fine until it's not, and then it's really not. And so there's a massive tipping point there, and it doesn't take much to tip over into that before, even in one tiny part of the business, for the whole business to be affected. So those points wherever you've got a lot of non-linearity that exists. I'm not saying this is the only way you can model it, but it's a simple, easy, and effective way. And particularly some of those indicators at the bottom are things that the business measures and monitors quite frequently. So it's a very simple, easy way to draw the link between some of those business input drivers and the key metrics that you ultimately want to measure. You don't need to build the biggest, fanciest, stochastic Monte Carlo type of model to be able to answer that.
So when that was put up on the screen, it made me think of one particular insurer that referred to the reputation issue. In recent years, I had the chance to spend a few days with them this month in New York with their meetings there. So it's AIG, just to avoid any mystery there. So we've got a particular interest in them and other large sort of complex insurers. And in fact, over 5 days there, we had meetings with 4 days. Some big, some small, some a couple hundred other people, some just them. Probably the most interesting one was over a beer with an Australian actuary that was their chief risk officer just in the run up to the crisis, and he'd been there for a few months. I used to work with him in a couple of places here, and just hearing some of his stories of the reputation obviously was a big issue, and they had an incredible recovery, paid back US government many billions, and in fact more than they sort of got the bailout from. But just sort of thinking through in that sort of environment, you go through lots of other things other than reputation. But have you sort of tried to case study these through in terms of just how this would work in a real stressed environment as against in more normal times?
I've done a number of case studies, a number of which have actually made it into various publications, but none in terms of picking out on a particular historic case study. Yeah, I have looked at a lot of the rogue trading that actually has happened, and that tried to get a sense of what was driving some of the rogue trading type of events. And that's a particularly interesting one in the banking space, because it's highly non-linear what actually drives that, and how do you possibly set risk limits to be able to try and control your tolerance to that type of operational risk outcome. You can model it, but it's no point over-egging the model. You're probably much better off thinking about the qualitative drivers that go into that around culture, around efficiency and structures and all those types of things, which most organisations do. And it's just trying to bring those pieces together so that you can link the two together in a meaningful way. Yeah.
Just a follow-on question, if I may. One of the areas that we get a lot of challenge on is in trying to build some global standards for insurers that they're inevitably going to clash with whatever local standards or whatever risk management approaches firms are taking, and that may lead to a conflict in terms of how you want to build a risk appetite framework and risk levels which are going to evolve in particular parts of the world, and then trying to overlay something which by definition is going to be different in terms of the conflicting drivers there for the management to try to keep doing what they're doing, but you've now got another set of parameters that might constrain the risk limits further and sort of further
something that's as economic as it can be, but can't be pure economics because there's lots of other things that are affected, volatility, concerns about procyclicality, and just trying to come up with something that there's going to be some degree of comfort of if people are running good risk management systems, that something new that's been overlaid or put alongside is not going to undermine good efforts of risk management.
I think you've really touched on this point around consistency of risk tolerances and risk limits, and that to me is the heart of all of this. How do you ensure consistency to the extent you're facing multiple constraints from multiple different stakeholders? It's really quite challenging until you kind of map all those out and think about what their interrelationships might be under normal operating conditions as well as stress types of conditions. Then it's really hard to kind of land on a particular solution. There's other cases where I've been involved in situations where those constraints have been set at too granular a level across too many variables, and it's artificially constrained the business in a way that hasn't been good for the business, in which case we've actually taken away those constraints and put a constraint at a more intermediate level, which actually provides business the flexibility to say, well, given this overall kind of intermediate, almost risk tolerance, so to speak, it gives the business on the asset management side the flexibility to be able to take risks in different asset buckets in a way that makes more sense and gives more opportunity for the asset managers to actually add value. So there's things like that you can do to tweak where you put the risk limits or tolerances to be able to get the behaviour that you actually want. Any other questions or comments?
Josh, just a related question. How do you achieve the balance of how far to drive the risk limits down an organisation? And related to that, in a complex system, how do you go about maintaining consistency of risk limits and explaining movement in risk limits over time?
I'm conscious not to hog the limelight here, so I'm happy to let other people answer, but I'll give some quick perspectives on that. It's a really hard thing to judge. Ultimately, it is judgment. To some degree, it comes back to there's probably two dimensions. One is how you cascade it through the organisation just from a governance perspective and get people to behave in the right way and be able to buy into the metrics and constraints. And the other is technically how do you actually derive those constraints, and it comes back to some of the frameworks that you need to be thinking about when you're dealing with those problems. So whether you're dealing you're modelling something stochastically and you want to be able to drill down instead causally below that. If you can actually articulate what the relationships are between the underlying causal drivers and the outcome, then and it makes sense to do that and you're comfortable with that relationship, then yes, you should do it. But if there's a lot of uncertainty in what those relationships look like, then there's no point.
I'll just add to that as well. I suppose irrespective of how far you cascade the risk limits downwards, they do need to be, well, first of all, easily monitored. And you also it needs to be very clear as to when that risk limit is actually breached. So if there's a conversation happening about whether the limit has been breached or not, well, then I suppose that limit isn't appropriate in a way. It needs to be very, very clear and very easily understood, I suppose, by those that are going to use it in the day-to-day operations of the business. So I think in addition, those three factors really need to be considered when deciding how far down you cascade the limits.
Other comments or thoughts? How are we going for time?
20 past 1. Plenty of time.
Okay.
That's on a slightly different slide. I'm one of the 90% who haven't read it, although I have printed it off. I've killed a few trees, but haven't done anything about it. So my apologies if it's in the paper, but what would you hope result of your paper? And perhaps, not to you, Josh, but generally to the committee, perhaps a couple of ideas from each of you would be great.
Well, of course, insurers have a risk appetite now. I mean, what we'd like to do is provide some additional insights on to improve the effectiveness of the risk appetite statement and the framework. So I'd like to think that the Point Actuary, Chief Risk Officer, etc., might be able to get some additional perspectives from our paper and to review their risk appetite, the effectiveness of that risk appetite, how it's fitting within the framework, could it be improved, how they set the limits, tolerances, etc. Risk appetite as part of the risk management framework, I think it's been said a number of times, we're on an evolution. So I don't think anyone can sit here and say that they're at the final piece of that evolution. So I'd like to think that we can provide some additional assistance to that evolution.
And as Paul said, obviously, life insurers already have a risk appetite framework to some extent in place. What we'd hope, I suppose, that would result from this paper is that there's clarity of language across the organisation when talking about risk appetite, because we, as Josh mentioned earlier, we spent a number of sessions actually just trying to figure out ourselves what we meant by risk appetite, risk capacity, a risk limit or risk tolerance. So yeah, we would hope, I suppose, this paper would help clarify some of the language that could be used. Secondly, I hope it'll start to stir some thoughts in people's minds about how to address some of the more challenging aspects of risk appetite. And from our point of view, that big challenge is actually having consistency and linkage between risk tolerances and risk limits. So that paper starts to prompt, I suppose, that discussion. And thirdly, from my experience, it seems that often the risk management division of an organisation has responsibility for a lot of the, I suppose, more qualitative type risks, such as operational risk, reputational risk, and some of the more quantitative aspects are looked after by the actuarial team. So I think from this you can see that there's a lot of techniques that might be used in relation to better understanding quantitative risks that can equally be applied to qualitative risks such as operational and reputational. So I suppose that's another area I think the paper has provided some guidance on.
And just to add to that, from a small perspective, I see in some risk appetite statements there's a confusion between outputs and inputs essentially. So there's tolerances that are clearly appropriate, and sometimes there's really, really granular risk limits. In some cases, even on risk mitigation aspects, and it just doesn't gel. So I think one outcome I'd like to see would be a clear articulation of what the risk tolerances should be at an aggregate high level that the board can really understand and engage with, and there's a distinction between that and kind of cascading that information at the next level of granularity for management and the operational or functional areas to understand what their appropriate risk limits are at different levels of appropriateness throughout the organisation. And it's just getting clarity on those two things, which kind of forces you to think about their interrelationships, I think is, a really valuable thing. Okay, any final questions? Okay, great. Well, thanks everyone for attending. Hopefully you got a lot out of it. So I'll call the session to a close.